How does over-diversification dilute your portfolio returns? Have you ever wondered how having too many investments can actually hurt your financial growth? Today, we will unpack the concept of over-diversification and its effects on your portfolio returns. Over-diversification happens when an investor holds an excessive number of different investments. While the goal of diversification is to spread risk, going overboard can actually dilute your potential gains. It is essential to find that sweet spot where you have enough variety without losing the benefits of targeted investments. At its core, diversification is about combining assets that do not move in sync. This helps reduce volatility while maintaining expected returns. However, when you start adding too many similar or correlated assets, the advantages of risk reduction quickly fade away. Your portfolio may end up mirroring a broad market index, where the performance of individual assets has less impact on your overall returns. For adults managing their investment plans, over-diversification can lead to several key issues. First, you may experience lowered returns. When you hold a large number of assets, especially those with similar expected returns, your overall return tends to align with the average market return. This means you could miss out on higher returns from well-chosen investments. Next, managing a vast array of investments can increase complexity and costs. More assets mean more transaction fees, taxes, and administrative work, which can eat into your net returns. Additionally, the positive impact of high-performing assets can be diminished. When you have too many holdings, the success of top performers gets diluted by average or underperforming assets. Another factor to consider is the Sharpe ratio, which measures risk-adjusted returns. While diversification can improve this ratio by lowering volatility, adding too many correlated assets offers little improvement beyond a certain point. Research suggests that adding more than 20 to 25 assets provides minimal additional risk reduction. If the assets are highly correlated, even 5 holdings might be enough before you see diminishing returns. The key for adult investors is to strike a balance. You want to achieve enough diversification to reduce unsystematic risk without overloading your portfolio. This means selecting a mix of asset classes, sectors, and geographic regions that are not closely related. Regularly rebalancing your portfolio is also important to maintain your desired allocation. In essence, over-diversification can dilute your portfolio returns by spreading your investments too thinly across many similar assets. This reduces the potential for significant gains, increases costs, and limits the effectiveness of your risk management strategies. Focusing on the quality and correlation of your assets rather than sheer quantity will help align your investments with your long-term financial goals and risk tolerance.